Hello, you're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Temur Beg, Chief Economist, welcoming you to our 72nd episode. The ongoing Russia-Ukraine conflict has starkly manifested in rarely seen spikes in the energy price market. So today, it's all about energy. With great pleasure, we welcome back Vandana Hari to Kopi Time. She is the founder and CEO of Vanda Insights, a Singapore-based provider of global oil markets macro analysis. Vandana has 25 years of experience providing intelligence on the global energy markets to stakeholders in the petroleum industry, policymakers, and wealth managers. Vandana Hari, welcome back to Kopi Time.
Thank you very much for having me back, Timur.
It's great to have you, and what momentous times we're living through, Vandana. We had you on Kopi Time back in July 2020 when WTI contracts were turning negative. So we have come a long way since then. And there is, of course, a lot to talk about the current juncture. But perhaps we could start by taking stock of the energy sector during this pandemic. How did the supply and demand for oil, gas, coal, the overall energy sector evolve across the world during 2020 and 2021?
So indeed, Timur, to borrow your phrase, a long way, but we have come that long way in a very short time. So we, in 2020, the COVID and all the associated nearly global shutdowns, as you might recall, caused an unprecedented crash in global oil demand. So for the purposes of our discussion, we'll go with 100 million barrels per day, which is very close to where oil demand was in 2019. Now, we saw demand crash by close to 8.7%, 8.7 million barrels per day, year on year in 2020. Now, as COVID began to abate somewhat, the curbs and restrictions were progressively removed through last year. The global oil demand is estimated to have recovered by about 5.4 million barrels per day. So we have, of course, a big chunk of the 2020 drop being made up, but certainly not all of it. Now, the real magic, if that's the word, is expected to happen this year, which is the rest of the demand that crashed in 2020 comes back, but not just that. Oil demand is expected to actually go back above pre-COVID levels sometime, could be middle of this year or sometime in the third quarter of this year. So 8.7 million barrels per day crash in 2020, about 5.4 million barrels per day recovery in 2021. And this year, on average, it could rise by another 3.7 million barrels per day or so.
So we will go back to a level that is higher than the 2019 pre-pandemic numbers.
Yes, that is the expectation, though a lot of market participants and watchers will tell you that we probably hit that level already at the start of this year, or will do so in sometime in the next few months. But in general, the consensus view is that we'll definitely be at pre-COVID levels, 100 million barrels per day, and vaulting over that sometime in the third quarter of this year.
Yeah, especially if I think about the US and India, in both cases, even the latest data suggests that economic recovery momentum is pretty substantial, and those are big two chunky sources of energy demand worldwide. Vandana, I'm going to stay with the last 2 years for one more moment, please. What happened with respect to investment and inventory? I know that with the green transition in mind, banks have become tough on financing energy, greenfield projects, and then countries have been making, proactive strategies and pivoting away from fossil fuels. So that trend was probably there even before the pandemic. What happened through the course of the pandemic with respect to investment and inventory?
So COVID and perhaps, the clean air and the blue skies that the world experienced in the lockdown period appears to have given a fresh momentum and impetus to the global efforts. I should say global demand aspiration from the public, the investment community, and the oil and gas community, the oil and gas major producers, refiners also joining in this whole groundswell of movement, as you say, a pivot from fossil fuels to cleaner forms of energy. Now, what has happened as a result of that is a dramatic drop in investment in fossil fuels. Now, within that, of course, there's a kind of hierarchy as well. So we have coal, which seems to be the most disliked, right up there in terms of governments and the public in general, and the investment community just wanting to cancel it out of our lives. But then unfortunately, that has then percolated down to oil and natural gas as well. So we have seen, and to some extent, it is understandable, because if investors and the oil and gas producers, whether you're talking of oil majors or independent companies or to even national oil companies, if they are going to shift their investments into newer forms of energy, then that money has to come out from somewhere else, and it has ended up coming out of oil and gas. So we've seen a dramatic drop in investments, and which was a kind of double whammy, because we saw a very similar slump in funds being put into finding and developing new oil and gas back in 2014 to 2016 as well. You recall prices slumped quite a bit. So this is the second round that we have seen, but it just seems to have a very different kind of momentum this time, one that doesn't look like it will slow, let alone reverse anytime soon.
And with respect to inventories, are we sort of, running thin on that, or globally there is decent inventory?
Yeah, so that's a very critical point to talk about, and one definitely in the bullseye of the market, especially. When we are trying to assess on a day-to-day basis or short-term or even medium-term basis what market supply-demand fundamentals look like. See, when we look at inventories, and here we're mostly talking about the OECD world, which is required to maintain a certain level of oil in storage as emergency reserves, typically minimum of 90 days worth of net imports. Now, these inventories also became a sort of target for OPEC Plus, as the organization was trying to figure out how to rebalance the market. So the rebalancing for OPEC was not just about curtailing supply and having supply demand match each other as the world came out of the COVID crisis, but also they wanted to substantially bring down the inventories that had built up through 2020. And global oil inventories had swelled to unprecedented levels. So what OPEC Plus did was they set a target of the average of OECD inventories over 2015 to 2019. They deliberately left out 2020 because that was an outlier number. So this target of OPEC Plus was actually achieved within the first half of last year. So 2021, early 2021, OECD inventories had already dropped to below their 5-year average of 2015 to 2019. But then what happened after that was OPEC Plus got onto a roadmap of very cautious, conservative easing of its cuts, deliberately keeping the market a little bit undersupplied. And we can talk a little more about OPEC later. But what that resulted in is a consistent, persistent drawdown in inventories throughout last year. And it was expected to reverse this year, but thanks to all the disruption in Russian oil supply, demand bouncing back a little bit more than had been expected, probably we are still in that situation where even in this quarter, global oil inventories are continuing to drain. Now, essentially, that makes markets very nervous, especially if in cases of supply disruption, because inventories are your very essential buffer, in the event of supply shock or supply disruption. And when these inventories are running thin, that becomes an additional factor for bull runs in the oil market.
So tight supply, low inventory. I can see the makings of a perfect storm, which now brings us to the present. Vandana, of course, Russia is front and center of all the discussion right now. So let's talk a bit about their situation. So Russia's economic isolation that is in the making through these wide-ranging sanctions that have been put in place, and perhaps more sanctions are coming, this could potentially choke off a major global source of energy. So underscore for us how important Russia is to the global market of energy.
Yes, absolutely. Very vital. So just to put that in perspective, currently Russia is the second largest oil producer after the United States, with an output of just over 10 million barrels per day if you're looking at crude. Of course, Saudi Arabia is a very close third behind Russia. Now, the world's second largest exporter of crude is Russia, Saudi Arabia being the largest exporter. Russia currently exports about 5 million barrels per day of crude. But in addition to that, it also exports about 2.8 million barrels per day of refined products. And these are all the crucial major refined products the world uses: diesel, gasoline, and fuel oil. If you look at natural gas, Russia is the second largest natural gas producer after the US, and it is the world's largest exporter of natural gas.
Okay. So both with respect to gas and oil, important marginal producer. So now some scenario analysis. What is your thought in terms of supply of energy from Russia? They sell a lot to Europe. They sell quite a bit to China. Can things be diverted from one place to the other? Can you turn off gas pipes? I mean, so that's sort of questions that I have in my mind.
Yeah, absolutely. So a major disruption in Russian oil supplies has already begun. Now, you might say, but wait, there is no sanction against Russian energy exports from the Western allies. There were some discussions over the past weekend, the US threatening that it is looking at imposing an import embargo on Russian oil. And it's important to make a distinction here. So one is the US could say we're going to try and put a ban on Russian energy exports. That would be very similar to what the US has done with Iranian and Venezuelan oil exports. But that's regarded as extremely difficult to implement. Not to mention that it would be absolute Armageddon in the oil markets. The other way is the US could say we will sanction the import. So we'll not import, and then try and bring the EU on board with that as well. So that has not happened. But what has happened is a slew of economic sanctions, and especially sanctions against the Russian central bank, major Russian banks that have already been rolled out by the US and EU in response to the Russian invasion of Ukraine. And what that has resulted in, a couple of things. So first of all, that has already disrupted, the entire financing that goes on around oil supplies, from the time they are lifted to boarded on a ship, a tanker, to reaching the end user. A second phenomenon that's happening has already happened in parallel is a self-sanction on the part of banks, on the part of buyers, traders of Russian oil, shipping companies, and of course, quite understandably, insurance rates on cargoes and loadings of Russian oil have also shot through the roof. So if we look at March and you recall the figures I gave you earlier about Russian exports, about 5 million barrels per day, let's say, of crude, 2.8 million barrels per day of refined products. Now, if you just look at March, the current estimates are, if things remain as they are now, about half of Russia's crude exports may not reach the overseas markets. Nearly all of Russia's refined products may not reach the market. So we're looking at a big time disruption already in Russian supplies. We have seen Russian crude Urals, which is a benchmark crude that goes into the European markets, trade at record discounts and yet not find buyers. So Russian oil disruption has already started happening. Russian gas supplies, so far from what we can see, are being maintained as per normal to Europe. And every day we have statements, especially from Gazprom, which is the major gas supplier, that sort of reassuring statements that we are continuing to maintain normal supplies. But I think herein lies perhaps another tool which could be absolutely devastating for Europe. And we did see that threat come out overnight with the Russian Deputy Prime Minister Alexander Novak saying that if the West proceeds with import embargoes on Russian oil, Russia would have to look at curtailing gas supplies to Europe. So that is the absolute nightmare scenario. To your point, can Europe replace easily the gas? The short answer to that, and quite a final answer, is no. So about 45% of European gas imports come from Russia, and a big chunk of that comes via pipelines. So a pipeline essentially just ties the consumer as much as it does the supplier to that trade. It's not very easy to divert, whether it's for the seller or for the buyer, to other markets. And I think that's going to be probably the biggest threat ever that'll be hanging over our heads until the Ukraine crisis is resolved, because Russian gas supply disruption to Europe is essentially going to mean lights out for the continent.
Vandana, I have two follow-ups. One, a technical follow-up, one, a financial follow-up. So technical follow-up is, can you really turn off a gas pipe? I mean, isn't it the nature of a gas pipe that you can't really turn it off? So explain to us how Russia can sort of, unilaterally stop supplying gas, and what happens to all that gas? And do you have to mothball a gas field? And the financial question is, every day Europe owes Russia hundreds of millions of euros for importing all this gas. With all these sanctions, how is that payment going forward? I'm curious to figure out how that is working out. I don't know if you can shed some light on that. So first the technical question and then the financial question.
Yes. So when it comes to gas, and for that matter, even oil, just, you can't just turn it on and off like a tap. But then again, we have seen producers do that in the past, especially with oil. When we talk about OPEC, non-OPEC curtailment of supply, they do switch off. It's not easy. It is a time-consuming process. And equally on the other side, when you're trying to restart a field, whether it's oil or gas, also you face major problems. And we're already seeing some of that. If I may just digress briefly, in a lot of OPEC countries that are finding it hard to bring oil back in line with the increasing quotas, because the reservoir pressure just drops. And if a field is shut for maintenance, let's say for a few weeks or a month, it's still manageable. But if it's been shut for 2 years, it becomes very, very difficult to achieve the same kind of rates of flow of oil and gas. And then the infrastructure problem is also on the receiving end. So if Europe were to say, for instance, that okay, if we lose Russian supply through pipelines, we'll just import more LNG. But then do you have that capacity at your LNG import terminals, the regasification capacity, and then the capacity for pipelines to send out that regasified LNG to the consumption centers? Again, the answer to that is no. Your point about Go on.
And I was just going to sort of, summarize all that. That sounds like it would be very, very costly, both for the Russians and the Europeans, to take a very drastic measure in terms of supply of gas.
Oh, absolutely. I think the damage in this war is going to be almost equal on both sides. And a part of me says, I think there isn't even a side. In a way, the whole world is going to pay the cost of this war, what with inflation and the kind of oil and gas prices that we're all having to bear now.
Right. So on the issue of the financing, the payments, any idea how that is happening every day right now, despite all these sanctions?
Yeah, your question is probably far more important than my answer is going to be. Unfortunately, I don't have a very clear view of how it's going to happen. But, clearly, Europe will have to find a way to continue paying Russia. It is traded, it is paid for in US dollars. And, I would imagine that the US and not just Europe, mind you, the US is also continuing to import Russian crude, about 700,000 barrels per day of it. So the US also needs to continue paying and must continue paying Russia for the imports. So I can only imagine that the US and the EU allies will find a way to ring fence that channel of payment. But I'm afraid, aside from that, I don't have any more insights on that.
Okay, so I'll come back to the geostrategic issues with respect to Germany and US shale and Iran and all that kind of stuff later. But one issue is the energy trading market itself. A huge market. There are oil and gas, spot and futures traders everywhere, including Singapore and New York and London. Billions of dollars of transactions happen every day. Are there losses and credit events happening around the ongoing spike in volatility?
So absolutely. The losses are already biting. Companies are facing major margin calls from brokerages, from exchanges. Although there's no entity that has buckled under in recent weeks, but that is not to say that unfortunately, that's not going to happen in the coming weeks, especially if this crisis drags on for longer. See, European utilities, gas and power utilities were already in the eye of a storm. If you recall the energy crisis of late last year, there were a few bankruptcies, a few companies just shut down, though it tended to happen on a level where the companies that were relatively small that were the victims of that crisis. But now it's a double whammy for these companies. So if you look at gas prices, for instance, yesterday, so I'm now talking about Monday, the 7th of March, Dutch TTF gas prices, which is a trading hub benchmark wholesale gas prices for Europe, at one point traded as high as equivalent to $600 per barrel. Can you imagine? So when you have price gyrations like that, they trigger major margin calls. Now, what a margin call? Simply put, it's the security money that utilities have to deposit as a guarantee that they will be able to deliver, that they will deliver on their forward contracts. Now, when prices swing this wildly, and especially when they go up, when they spike, utilities have to top up those funds. So sometimes companies will enter new hedging positions to offset those calls. Sometimes that's just not possible. Sometimes that's even risky to do so. So companies also end up borrowing more from banks. We saw a host of German utilities, for instance, just at the beginning of January. I suppose, little did they know, they were coming out of the energy crisis hit of late last year. Perhaps little did they know that they were going to just hurtle into another crisis. But just at the beginning of January, we saw German utilities take out new credit lines from banks. Then we have a whole gamut of other participants or players, even speculative traders around all these trades, in throughout the supply chain that they are speculating on the price moves. And of course, as history has taught us, a lot of these speculative traders, unfortunately, do get burnt when we have absolutely wild price swings like we're seeing now.
Yeah, truly, truly extraordinary. I mean, a lot of these hedging strategies are based around models that find their estimates from historical data. And once you have, 3, 4, 5, maybe even 10 standard deviation away from the mean type events happening, none of these models can handle those things. So the pain would probably be substantial. This sort of volatility is unprecedented. Vandana, I'd like to shift to some questions on dealing with this crisis. The first one is a blunt one. Why can Germany, which is so beholden to gas supply from Russia, simply just restart its nuclear energy plants? I mean, it has the skills and material and the grid, right? So why can't it just get going?
Yeah. So to put it equally bluntly and succinctly, like your question, Germany regards nuclear power as dangerous. So it has even opposed the European Union proposals in recent weeks and months for the technology to be a part of the mix. Especially as in the transition to cleaner energy, the options are very, very limited. Now, what Germany wants to do is it wants to increase its reliance on natural gas as a cleaner alternative till it has other cleaner, greener energy alternatives available. We have seen the Nord Stream 2 gas pipeline, which completed construction from Russia to Germany at the end of last year, but unfortunately has gotten tied up in this Ukraine mess. And even before that, it was pretty controversial, and it's always been opposed by the US and a host of European governments as well. But so this is Germany's game plan, right? It had been veering away from nuclear energy for decades. The accidents, the 3 Mile Island accident in the US, then we had the Chernobyl in 1986. And the final nail in that coffin was the Fukushima nuclear plant disaster in Japan in 2011. That was when Germany said, this is it. We are not only not going to build any more nuclear reactors, but we are also going to decommission the ones we have. So in 2021, nuclear power accounted for about 13% of German electricity generation, and it came from 6 nuclear plants, of which 3 were switched off at the end of last year. That leaves Germany now with 3 nuclear plants, which are going to be turned off through this year. I think the last of the plants to be turned off in December this year. Now, so there is a very, very strong popular public opinion against nuclear reactors. But to the question that perhaps could they at least suspend, they could still stick with the phase out plan. But just in view of the current circumstances, could they could they delay it? So that's also seems quite difficult now, because in recent weeks, those have been the conversations that have been happening in Germany between the government and the utilities that run the nuclear power plants. And the utilities have said that, sorry, it cannot be done. They say that the shutting down process, because they were following this roadmap set out back in 2011, and they're saying that the shutdown process has progressed to the extent that any reversal at this point could become a major security risk. And then, of course, they're saying that we don't have, we haven't secured the fuel either. So it seems very, very difficult for Germany. It has painted itself into a corner as far as trying to get out of at least the current crisis is concerned. Now, of course, that's quite a contrast from neighboring France, which is which is modernizing its old reactors, but also building new ones. But we'll perhaps leave this for another day. But just tells you how divided and fractured the European Union is when it comes to coming up with a cohesive, coordinated energy policy. And I unfortunately I feel that this is going to run that continent, the region, and in turn the world into more bigger problems as we hurtle down this path of energy transition.
Okay, Vandana, so nuclear energy not on the table as much as we'd like it to be. Europe is divided on these issues. So what about temporary relief? US shale, Iran, Venezuela. What's your view on that?
Yeah, so these appear to be some of the safety valves, but neither of them is close to a perfect one, let alone one that is ready, because we need the oil right now, or some would say yesterday. So Iran can supply an estimated additional 1.3 million barrels per day of oil to the market if the US sanctions against its oil are lifted. Now, of course, negotiators from US and Iran and from the other signatories to the 2015 nuclear deal have been very hard at work actually negotiations began last April. And they have continued and have taken on quite a momentum in recent weeks in Vienna. But a deal has continued to elude them. Now, of course, we've been hearing, and it's been, the market has been optimistic every now and then in recent days that a deal seemed to be within reach. But there have been major disagreements between the US and Iran throughout the negotiating process, and some hurdles still remain. The latest one appears to be Russia, actually, which is one of the signatories to the 2015 nuclear deal, has demanded written guarantee from the US that Russian trade with Iran, and particularly military equipment and technology, will not be impacted by the US sanctions against Russia on account of Ukraine. So that seems to be the latest setback to the deal. So it's like, when it happens, it happens. We can't really hold our breaths for it. So if you look at US production, that plunged quite dramatically in 2020 from an all-time high that it had hit in just the year before of about 12.3 million barrels per day. So in 2020, we saw it come down by 1 million barrels per day. In 2021, another 140,000 barrels per day. Now, this year is expected to be the turning point. So if you look at the US Energy Information Administration's projections, it is expecting an 800,000 barrel per day year-on-year recovery in US production, reaching about 12 million barrels per day, they think, this year. But there are question marks around that. There are quite a few industry participants in the US and outside, and industry observers who doubt that US production will come back up by as much as 800,000 barrels per day this year. If you look at the shale sector, which accounts for 72% of US crude production and 100% of the growth in US oil output, we see, of course, a continuing mantra of cash discipline within the shale players. So as they have been reaping more profits through last year, and of course, continuing to this year, they have been returning more money to the shareholders. So they've been increasing dividends, they've been conducting share buybacks, and they have been paying off debt. So essentially doing all the right things as far as their lenders and shareholders' demands are concerned. Now, the capex is increasing. A lot of them are modestly raising their capital expenditure plans for this year. But the argument there is that a lot of that increased funding will be taken up by a rise in costs. So material costs as well as manpower costs for the shale sector have gone up considerably. So that's the US situation for you. If you look at Venezuela, also reeling under US sanctions, also imposed under the Trump administration, starting in January 2019. But even before the sanctions, Venezuela's oil sector was in a shambles. So, look, first of all, it looks a bit difficult for me for the US to just remove Venezuelan sanctions in one go, especially given how much time and effort it has taken them to try and revive the Iran nuclear deal. So, and even if they do, even if they ease on Venezuelan sanctions, given the state that Venezuela's oil sector is in, I wouldn't expect perhaps more than 300,000 barrels per day increment from Venezuelan oil. So as things stand now, there isn't really an obvious and immediately available relief valve for, if one were to contemplate a persistent, drawn out Ukraine war and a persistent disruption of Russian oil supply.
Even if we scan the Gulf horizon, say Kuwait, Qatar, Abu Dhabi, it really doesn't make that much of a difference.
So let's talk about OPEC Plus, and it's worth talking about it separately. So what we have seen with this alliance is that since the middle of last year, they drew out this roadmap for a very conservative, cautious 400,000 barrel per day increment, such that monthly increment in their production targets, such that they are able to unwind all the remaining cuts. They had made nearly 10 million barrels per day of cuts at the peak of when COVID hit in 2020, unwind them completely by September this year. Now, we have seen the alliance being very resistant, almost loath to deviating from this trajectory. Even at the height of the energy crisis late last year, US, other major consuming countries were knocking OPEC Plus's doors. Can you put more oil into the market? And they said, sorry, no. Now, host of reasons for doing it, but one of those is as the de facto leader of this alliance, Saudi Arabia has its energy minister has said time and again that they prefer not to react with or respond with more oil to the market when there are speculative spikes in oil prices. And they could argue, and they have argued, that the run-up that we've seen in prices since the start of this year is mostly fear-driven. It's a fear premium. It's speculative, not an actual change in supply fundamentals, to which I would disagree. Certainly, a lot of the market participants today would disagree. But that is what it is. They just don't seem to be inclined to move away from that path. Now, another big problem for OPEC Plus is that they have actually been falling way short of that target every month. So the target itself has been rising by about 400,000 barrels per day, exactly by 400,000 barrels per day each month, but they have been falling short of meeting that target. And in the latest months, as much as 1 million barrels per day. So that tells me that OPEC Plus is almost in a way intent on leaving the market a little bit short supplied, ensuring that inventories continue to drain, because they have been projecting a considerable build up in inventories through the rest of this year. The other problem that they're facing, of course, is that a lot of the members are struggling to revive output. So as I mentioned earlier, the reservoirs lose pressure. The infrastructure is, if it's not being maintained, for lack of funds, which was indeed the case in a lot of countries through 2020, you're just not able to go back up to your pre-COVID production capacities. And that means a lot of members are underperforming versus their quotas. Now, there is a handful of OPEC Plus producers, and concentrated in the Middle East. So you have Saudi Arabia. So we'll leave Russia aside for a minute, obviously. But you have Saudi Arabia, you have Iraq, Kuwait, UAE, that do have ready spare capacity. But until OPEC perhaps goes back to the drawing board and rejigs the individual member country quotas, these countries cannot just go and violate their quotas and pump more. So that's a problem for OPEC Plus as well. Arguably, they could suspend the quota system entirely for a short period of time. But again, as I say, right now, they just don't seem inclined to do anything.
Okay, this is all very grim, Vandana. So I'm going to ask you the $1 trillion question. How high can oil go?
So we have seen $200 a barrel number popping up in recent days. We had the Russian Deputy Prime Minister Alexander Novak warning oil could hit $300 a barrel. Now, of course, he was wanting for his threat and warning to be effective. He said that would happen if the US and EU embargoed Russian oil imports. But I would stay away from predicting an oil price. And the reason for that is we just in our lifetimes, we just haven't seen a situation like this where potentially 8% of global oil supply could be locked out, and a significant amount of gas supply could be locked out, for which there's absolutely nothing to offset it. So, how do you even begin to price in that kind of a disruption and, Armageddon? I might have used that word before in the oil markets.
Oh, gosh. All right. Well, we'll have to keep our fingers crossed and hope for the best. But clearly, the scenarios that you're painting are very worrisome. One big picture question before we wrap up, Vandana. What will be the legacy for energy policy from these momentous days?
So I think there are some huge lessons to be drawn, and I would hark back a little bit to COVID, the energy crisis of last year, and now, of course, this Ukraine crisis. First of all, energy security. I think you just cannot overestimate the importance of governments, the industry, and all the other stakeholders in this whole movement of energy transition. You cannot underestimate the importance of securing energy supply first. Related to that is, I think we need to take a really close, hard, dispassionate look with tangible numbers as to what is the oil and gas supply that we will need in the coming years through the transition and into the utopian world of minimal fossil fuel use. How much of oil and gas will we actually need? And then tie that back to how much investment do we need to continue making in oil and gas from to ensure that we have adequate supply. Otherwise, we are at the risk of bigger, more frequent supply shocks and price shocks. Now, when you look at alternative energies, of course, hydrogen, but hydrogen is still a lot into the future. It's not really commercially viable yet. You look at renewables, all good. We are also in the danger of rushing into a very simplistic but a very dangerous solution in our minds that, we'll just replace all our fossil fuel use, especially in the transportation sector, which uses most of the liquid fuels, with electricity. But, without asking ourselves, where will that electricity come from? Do we need to, how much? Renewables are good. They are rising very fast. From a very small base, though, very soon, if not already, they're going to hit their capacity. So I go back to saying, oil and gas are essential. We need to keep that firmly in view. We need to make sure we continue making enough investment, because jeopardizing the world's energy security, and now all the more so with, we are still vulnerable economies as we come out of the COVID crisis. We just cannot afford to jeopardize energy security.
Absolutely no room for complacency. Vandana Hari, thank you so much for your time and insights.
Thank you very much for having me. My pleasure, Taimur.
Thanks to our listeners as well. Kopi Time was produced by Martin Taki. This is Martin's last episode producing Kopi Time, and I can't thank him enough for his support over the last 2 years. I wish you the very best of luck on your journey onward, Martin. Daisy Sharma and Violet also provided production assistance for this episode. Kopi Time is for information only and does not represent any trade recommendations. All 72 episodes of Kopi Time are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.